Hello, chart watchers, and welcome to this Thursday, May 31st, Market Watchers Live Show with your hosts, Tom Bowley and Aaron Swinland. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Taking a look at the action so far today, Dow Jones Industrial Average off its earlier lows, but still down 172 points. The S&P 500 doing better on a relative basis, but still down 6 3/4. The NASDAQ actually breaking to a new high after breaking out yesterday. We're tacking on some additional gains here, up 17 points. The Russell 2000, after breaking out to an all-time high yesterday, seeing a little bit of profit taking today, down 5 points. 10-year Treasury yield hovering right at about that 2.84, 2.85% level. Volatility, even though we have seen some big movement to the downside on the Dow, the volatility index only up 0.10. So very minor increase in volatility. Consumer staples having another bad day. This is a group that's been lagging the market for the most part pretty severely over the past several months, and it is losing ground again today. Industrials also having a rough day. We are holding above that 20-day moving average. We are holding above the reaction low we saw back in mid-May, but we are down almost 1% nonetheless. Procter & Gamble having a rough day within that consumer staples area. You can see the stock down more than 2%. GM on some positive news on an investment in a driverless car, or their driverless car, up $4 today to over $42, leading a pretty strong auto group. Dollar Tree and Dollar General, a couple of specialty retailers, both down on earnings news, and you can see breaking down below 2-month lows. So let's turn it over to Erin, who is joining me today. Happy Thursday, Erin. It is Thursday, right?
Hey, yes, it is Thursday, and that means tomorrow's Friday, so that's always good news. But
Yes.
I know you have some really good news today.
I do. Of course, my Capitals tied it up yesterday in the Stanley Cup Finals. Big. That was another very exciting game. I mean, I'm not going to have any fingernails left after these 7 games. They keep.
I know, seriously, right? And they pulled it off in Vegas, so nice job, Washington Capitals.
Well, it was going to be interesting going into the series because Vegas has been, this whole Stanley Cup playoffs, if you've been watching, has been kind of strange in that many visiting teams have been winning. But Vegas has been one of the teams that's been holding their own on their home ice. I think they'd only lost one time in the playoffs at home until, prior to last night. And the Caps have been very good on the road. I think they're 9-3 now on the road in the playoffs. So I figured one of those two, either the Caps streak of winning on the road or the Knights playing so well at home, something had to give. And so I guess Caps were able to exact a little revenge last night and even up the series. But anyhow, I could talk all day on hockey, and I don't think anyone wants to hear it. I don't blame you. So let's move on to and the schedule, upcoming schedule.
Yes, well, we have to give everybody a chance to get into the room. All right, for the rest of the week and into next week, tomorrow I'm going to be doing a monthly decision point report. I'll go over all those monthly charts that have just gone final as of tomorrow. And then on Tuesday, I'll be doing a workshop. I'm still not exactly sure what I'm going to do it on. And then we have author Charlie Kirkpatrick coming in on Wednesday. So it should be an exciting week to get started with. And then finally, of course, on Tuesday, actually, that looks like Wednesday. Tuesday is when they usually come in. It seems like we're going to be doing Friday. Everything stock charts on Friday. So that'll be a great session as well. But for today, let's look at today's agenda. And we're going to start off with a June seasonality report from Tom. He is the seasonality guy. So it'll be interesting to see what we have for next month. Nike will be our first symbol in the 10 and 10. And then we will be doing a segment called Just Make It Stop. And that will finish off the day. So let's move on to our technical headlines and news. Tom, take it away.
All right. I was a little surprised at some of the reaction today. Of course, there are talks again about some tariffs on steel imports and so forth this time in Europe. And so there's just a lot of discussion about what's going on there. For me, I think a lot of it's just noise. I think it's bargaining, trying to figure out how to bring some of these folks to the table and maybe make some of the trade agreements more favorable for the U.S. But anyhow, the market, we're seeing volatility. Unlike anything we saw back in 2017, it seems like we do react quite a bit to headline news this year. Last year, it didn't seem to matter what came out. We just kept going higher. But we had some pretty decent economic news out today. You've got the 10-year Treasury yield up on your screen. And the initial jobless claims came in better than expected, 221,000 versus 224,000. That was what was expected. April personal income then came in and matched expectations, rising 0.3%. But April personal spending came in better than expected, or higher than expected. I would think that would be good for the market. But April personal spending rose 0.6%. The market was only anticipating 0.4%. May Chicago PMI at 9:45 Eastern Standard Time came in much better than expected, 62.7. Market only looking for 58.4. But then we did get a blow at 10 a.m. April pending home sales. The market was anticipating a rise of 0.4%, but we came in with a decrease, a sizable decrease, minus 1.3%. So that was a huge miss. And you can see that there really hasn't been a whole lot of a reaction in the bond market to all of this that's going on. It seems like we had this huge drop. We bounced back yesterday, and now I think the market, both the bond market and the stock market, are just kind of wondering, where do we go from here? What's going on? And so 10-year Treasury yield almost unchanged on all of this that's taken place today with the trade war news, potential trade war news, I should say, and all of these economic reports, some very good, some very bad. And when I looked at the intraday, if we pull up the 10-year Treasury yield on an intraday basis, I was really surprised that at 10 o'clock with that pending home sales number coming out so weak that we didn't see perhaps a big drop in the 10-year Treasury yield. And also, I was surprised that from a home construction standpoint, if you pull this up on the 10-minute chart, at 10 o'clock, we definitely took a little bit of a hit, but we came back up and cleared where we were when this news came out. So I'm beginning to wonder whether or not a lot of the bad news is already built into the home construction group. If we take a look at that daily chart, which goes back, this is a 6-month chart, you can see that we made the big drop. So far, after breaking down below this 800 level, we've gone down, put in a double bottom, and the group is starting to try to move higher. And like I said, with the not so good news out on pending home sales this morning, I think the group's holding up pretty well, especially on a day when the Dow was down as much as it was earlier today. So it does make you wonder whether or not a lot of the bad news is already built in to these home construction stocks, something to keep in mind as we go forward. Moving over to the sector summary, I'm going to go ahead and update this. You can see today so far, utilities leading up 0.5%. Technology also having a strong day. I want to talk about this in just a minute. But then you can see 7 of the 9 sectors are actually in negative territory. Consumer staples being hit really hard to the downside, down 1.6%. And then industrials also down 1%. Financials trying to find their way after the big drop we saw on Tuesday. Yesterday, we got a big bounce in the group. And now today, we're back down a little bit. But if we pull up that XLF chart, I think it's pretty clear. We've got solid support at 26.75. And earlier today, we got back down as low as 27.10. We're not that far from a key support level on the financials. So this is going to be an area of the market I think that's definitely worth paying attention to. If we go within the financials, if you click on the sectors, you'll get the industry groups that make it up. And you can see financial administration doing pretty well. This is going to be the area that houses, PayPals and Squares and so forth. But if you go all the way down to the bottom, you're going to see that mortgage finance, very weak. I'll talk about seasonality in a bit, but mortgage finance, not a good performer in June and not doing very well as we head toward June as well. But the thing that bothers me really isn't the mortgage finance. It's investment services, banks, and life insurance back down near the bottom of this, at least the industry groups in the financial space. Here you've got the life insurance, very important support level that we went down and tested on Tuesday. Huge bounce in life insurance yesterday, but we are moving back down again today. I'd be concerned if we lose 750 to 755 here. And the banks, very similar. The 450 area, 450 to 455. You can see that over the past several months, we've gone down into this area, but we bounce. Tuesday, we went down, hit 455, closed a little bit above that. Had a nice bounce in the group yesterday, but today we're back down again. What we really want to see, or what these groups want to see, is the 10-year Treasury yield moving back again toward the upside. And for now, that has been a problem. A couple of stocks that did report earnings that I mentioned at the opening, not doing very well. Dollar Tree, this is a gap down where we actually gapped below the prior support level. I'm going to annotate this so you know what I mean. And when I talk about gapping below the prior support level, I'm talking about the candle bodies, not the intraday tails here. So here is the open. Actually, I could pull this up. You can see today's open, 88.27. The actual close back here is somewhere around $89, maybe just a little above $89. So the open today was beneath that support level. I don't like to see that. I think that's a little bit of a clue that we could be in for some trouble. After gapping down, we came back up. You can see the intraday high test that level and then quickly sold off again. So DLTR on very heavy volume, losing a major support level. I don't like it. DG, Dollar General, same thing, or very similar, I should say. DG, you can see losing the most recent support level, but still holding on to the March level. So on a relative basis, if I had to pick between the two, I'd favor Dollar General just because it is still holding on to the support level, and it's actually gone back down and for the first time tested that mid-March gap support to the downside. Here was your gap up all the way to 96 from the prior day's close just below 89. We got close in late March to testing that gap, but we never did it until today. So we could see a recovery on DG. I mean, obviously we could see one on DLTR as well, but I am a little concerned about DLTR because we gapped below support, whereas we have a couple areas where we can, maybe look for a rebound and some buyers to come in on Dollar General. GM, there was an announcement that came out on GM that there would be a multi-billion-dollar investment by SoftBank Vision Fund in GM's driverless car unit. And this is a massive gap up. And look at the volume coming in. We're not even we still have a half an hour to go to the halfway point of the day. GM has already traded almost 35 million shares. And when you look back over the last 6 months, that's a big, big number. In fact, we could stretch this chart out a little bit. I'm just going to pull up the last 3 years daily chart. And when you look across here, you can see that the highest volume we've had in the last 3 years is maybe around 43, 44 million. And again, today we're already at 35 million. This is a big deal, not only because of the volume coming in, but if you look at the recent downtrend in GM, I think this gap up breaks that. So I would be looking for continuing strength on GM. I mean, maybe we pull back into this 39.40 area at some point, which would be a much better entry point from a reward to risk. But I think GM is going to head back toward this 46 area based on the break of this downtrend line and the volume that's coming in on this move to the upside. So definitely worth watching. I do want to turn our attention to a couple of upgrades and downgrades. And for that, Erin, why don't you take it away and go over those upgrades and downgrades?
Absolutely. Okay, we have 3 upgrades and 2 downgrades today. And I know at least one of them we had requested as one of our 10 and 10. So you get to see it now. And that would be Micron. Somebody had requested that. So we have 2 downgrades and there's our 3 upgrades. I'll go ahead and look at the downgrades first. All right, so Micron, I do hold this one, but it's a long-term holding, so I'm still in. Anyway, here we go. So this one, although downgraded, I'm not overly worried about. It's still a pretty strong company. Relatively speaking, when you look at the scooter, we're still seeing, a 97.8 ranking. So, I'm not overly worried. Look at the OBV. We are seeing some very heavy volume to the downside today, obviously, but I think overall, when you look at this, we're looking at a pretty good pattern. I am seeing that top on the PMO, but we're having a 6% down day, so it would be really unusual to see the PMO continuing upward on a 6% decline. I see this gap area as some very important short-term support, possibly just a little bit lower there to cover that gap. The expectation when you get these gaps like this, especially when we're getting a pullback, this is similar to an island formation, and you should expect the gap to close. So I am expecting that gap to close. So my stop would be a bit lower than that. I would say that, I still don't think this looks bad enough to be bailing on it as an intermediate term investor. But if we start getting really, really low, then I'm going to start worrying if we get down to that 52.50 area. So that's what I'll probably be watching, right at that 50-day EMA. All right, downgrade, PACCAR. And, on this downgrade, we're down over 2.5%. We were already seeing the momentum slowing and turning down. Notice the difference between this downgrade and Micron, the one we looked at before. In this case, we have a very weak scooter that is getting weaker. You can see that the OBV has already been trending down. And like I said, we already had a top here on the PMO. I'm looking for this one to fall down to test that area at about $60. I don't think this one's done falling on this downgrade. Looking at the big picture here, I'd probably want to look at a weekly just because I'm seeing what could be a Head and Shoulders top. So I want to get a better look at that. Not the monthly, the weekly. Yeah, so you can see a Head and Shoulders pattern here coming up this really long uptrend. And if, at this point, it's executed because that area right there was the neckline right at $65. So we got that execution of the pattern, and the expectation is a drop that's about the size of the pattern, the height. So that's a pretty serious drop ahead, in my opinion. So I would be staying away from PCAR. Biogen is one of our upgrades. And again, you'll notice I decided to highlight the indicators in particular on these just so you can get an idea of sort of the difference, especially with those two downgrades. I think it's important to look at those indicators because it tells a very different story than just the fact that it was downgraded. So now we're looking at some upgrades. We have this really nice rounded bottom. I like the looks of that. We got the breakout. I would say right here, you can see some pretty important resistance that's just been broken. I think there's still some more resistance to be met with, and that would be probably about that 305, 307 area, just right here where we had, a trading range going on. So I think that's going to pose a bit of overhead resistance, but looking at these very strong indicators, I suspect we'll see it pop on up above that. I'd be looking at a target around 330. But you could certainly make a case for 350 and even 370. So on an upgrade, Biogen looks pretty darn good. Corning, GLW. This one had sort of I have a mixed review on. We did get the upgrade, so we got a nice 3% move right now. And that makes, that's nice because it's coming off, it's bouncing off this area of support right at about $26. So with today's gap up and move, we got that bounce that we want to see at the bottom of that trading range. Unfortunately, it's already moved itself up over halfway to the top of that trading range, but we do see the PMOs turn back up. So we got somewhat of a bull kiss. It wasn't actually a kiss. It didn't kiss the line and then move back up. But, we got that whipsaw here. This is the problem, though. The volume is just not very healthy. Scooter is still very weak. And like I said, we're already like over halfway up into that trading range. So I'm not looking at this as a particularly good opportunity off of the upgrade. But if I was holding it, I'd certainly stay with it. All right, Momo was also upgraded today. And again, I think we've got really strong indicators going on here. You can see that the acceleration, obviously, of the PMO on that gap up. My only concern right now with Momo would be we are getting to this area of overhead resistance and we've formed an island. And, islands can turn into reversals. That's why they call them island reversals. And if you look in the thumbnail, the expectation, if it does turn out to be an island reversal, is a closure of this particular gap, and that could be quite painful. But I think the indicators look pretty good. If we can get a pop above this overhead resistance, I think that would make it a much better choice, but I think the major run has been had here off of that buy signal. I'd still hold it if I were holding it at this point. And that is all of the upgrades and downgrades I was going to go over today. I think it's time. Let's go ahead and Tom, are you ready for your seasonality report?
Absolutely. I love talking about seasonality, so I cannot wait to get into it and share some things with folks.
Excellent.
Yeah, so let's go ahead and start that up. I do want to say that seasonality for me is simply another indicator. It's not it's not my primary indication. It is my secondary indicator. So, for instance, if I am bullish the market and I know that seasonality is favoring moves to the upside, then that's going to give me more reason, more confirmation on the position that I'm taking, looking for the market to go higher. If I look at the market and I think it's going to go higher, and seasonality tells me that we're entering a bearish period historically, I'm still going to go with my gut, or not my gut, but my initial technical view of the market in terms of what I invest. But if I know that seasonality is against me, then it's kind of like when I'm getting into a stock, but I know there's a negative divergence. It's just something that might make me think a little bit more about keeping my stop tight. Maybe I trade fewer shares, but it's not going to change my impression from being bullish to bearish because of what seasonality does. So it's just another indicator to me. For me, when I look at the charts, it's all about price and volume. So when I look at the MACD, or I look at the PPO, or I look at the RSI or stochastics or seasonality, any of these other things, they're secondary indicators. So I just want to be clear, because I don't want anyone to look at the seasonality as being, oh, well, the market has to do this because this is what it's done in the past. There are no guarantees in the market. Okay, so having said all of that, let me go ahead and get started. I want to just let you know that there are times within a calendar month where the market does tend to be more bullish. There are other times of the calendar month where things tend to be more bearish. But the first thing I want to do is start off, and let me just show you the seasonality and how you can get into some of this information. So from this drop-down menu on the members dashboard, you can see you can choose a lot of different ways to look at a stock or look at the market. One of those ways is seasonality. So you click on that, and then I'm just going to pull up the S&P 500. The default is 5 years. So what this chart is telling you, if you're not familiar with it, is that over the course of the last 5 years, these bars represent the percentage of times that the S&P 500 has been up over the last 5 years within this month. And of course, if it's zero, then it means that they've been down, that the S&P 500 has been down every month over the last 5 years in that particular month. Now, you can look at this over the last 5 years and draw conclusions, but your conclusions might not be good conclusions. For instance, you might look at this and say, well, April and May are the two best months of the year because they've been up 100% of the time last 5 years. And over the last 5 years, maybe that's the case. Although October, when you look down at the bottom, is actually averaged gaining 2.7% over the last 5 years, and that's the biggest average gain when you look back over these last 5 years. So in addition to seasonality taking a backseat to technicals, the other thing is that anytime you're looking at history, the bigger the sample, the more reliable I think it is, the more representative that sample is. So here, this is, call this the slider. And so the default is 5 years, but if you actually left click on the left side of this slider and drag it, you can go up to 20 years. And so now when you look at it, it may not look exactly like it did after 5 years. In this case, we have April still doing very well over the last 20 years, up 75% of the time and averaging 1.7% gain. You can see October averaging 1.8%. So on the S&P 500 over the last 2 decades, October's been the best month. Now, I've got a spreadsheet where I go back and look at the S&P 500 since 1950. So that goes back almost 7 decades. So if I stretch it out, I'm going to find that October is not the best month of the year for the S&P 500, that in fact, November and December are better than October. If you look at the NASDAQ, January since 1971 has been the best month. So just keep in mind that this is all great information, but it's not a guarantee, and it doesn't give you, in all cases, a full picture. For instance, this is limited to 20 years, so we can't go back before 1998, 1999. Now, talking specifically about June seasonality, the S&P 500, now that's what I'm showing here, but keep in mind this chart only goes back 20 years. Since 1950, the S&P 500 has risen 35 times during the month of June. It's fallen 33 times. And the average gain, well, I should say the annualized return, not average gain, the annualized return for the month of June over the last 68 years on the S&P 500 is a positive 0.07%. So in other words, since 1950, Junes have roughly gone nowhere on the S&P. That ranks June 10th out of the 12 calendar months on the S&P 500. The only 2 months that June does better or performs better than for the S&P over the last 68 years is August and September. August and September both have negative returns since 1950. And like I said, June is flat. The NASDAQ, we'll go ahead and pull this one up on here so that you can see it, but I'm going to go back. I'm going to give you data that since 1971. So we're going back. Oops, I think I need to put in Comp Q. So I'm going to give you information that dates back to 1971 or the last 47 years. This, again, only goes back 20. So the information I give you may not line up exactly with what you're seeing here. But the NASDAQ over the last 47 years has risen 25 times in June. It's fallen 22 times in June. Its annualized return, though, is 9.24%. That's not bad going back over 47 years. That ranks June as the 8th best performing month of the year on the NASDAQ out of the 12 months. The Russell 2000, and I'm going to spend a little bit more time on the Russell 2000 for this June seasonality report, and I'll tell you why in just a second. Maybe you will see why. But the Russell 2000 over the last 20 years has averaged going up in June 0.8%. Now, if I go all the way back to 1987, which is roughly 30 years, 3 decades, June has been higher 18 times. It's been lower 12 times. So there are some pretty good odds that it goes higher. Its annualized return is only 3.27%, which ranks 9th out of 12 years. But here's an interesting thing about June. The Russell 2000 over the last 20 years, look at this average percentage, 0.8%. That's the average gain over the last 20 years. I'm going to go back and show you that S&P 500 again and pull it back 20 years and compare. I want you to look at the S&P over the last 20 years during June. Minus 0.7% is your average. Now, I could look at it and say, well, the Russell 2000 is an outperformer on a relative basis to the S&P by looking at both of these charts, or I can just compare the two. So I'll show you how we do this. Keep in mind before I pull this up that the Russell 2000 was plus 0.8. The S&P was minus 0.7. So the difference is 1.5%. And when we do this and I drag it back the last 20 years, I want you to see that June average, the Russell 2000 has outperformed the S&P 500 by 1.5% on average over the last 20 years. And the Russell 2000 has outperformed the S&P 500 79% of the time going back the last 20 years. And that is the best month of any of these months. So I know that there's this saying out there, this old Wall Street adage, go away in May, and then you come back at the end of October, that November through April is the best time of the year. And that's a very cute little saying, go away in May. And there are some reasons why that there's truth in that statement, but there are also some reasons why I don't follow it. I don't go away in May. And one of the reasons is because the Russell 2000 has a pretty good track record in May and June, both months. And you can see the outperformance. Like I said, this is the best month of the year for outperformance by the small caps. So what I want to do, you can kind of sit down. I'm going to pull up the Russell 2000 on a chart here, but I want to just tell you during the month of June how the Russell 2000 tends to perform. The first and second of the month, and I'm not talking about all calendar months. Again, I'm just talking about June right now. June 1st and June 2nd have produced annualized returns of 116.44% going back the last 30 years. June 3rd through June 14th, that return is negative 19.58% over the last 30 years. Then we have another quick pop, right? Once we get to the 15th of the month. Now, keep in mind, as we go through this, think about when money rotates, when money comes into the stock market. And I'll talk about that more in a second. The 15th through the 17th, the Russell 2000's average or annualized return over the last 30 years, June 15th to June 17th, 46.03% positive, 46.03. Then we go into another bearish period, the 18th through the 24th, where the Russell 2000's annualized return is a minus 54.59%. And then we get into another bullish period as we close out June 25th through the 30th, positive, plus 63.63%. Now, I want to go back and talk a little bit about the first and the second, and then the 15th to the 17th. Because when I was in public accounting and I audited companies, what I found is that most companies had 401k plans, and many of those companies had pay periods that would run or get, many companies would pay right around the 1st and the 15th of the month. Some might be the 31st of the month. Some might be the 1st and the 16th. But there were an overwhelming majority of companies that I audited that had payroll periods that fell middle of the month, end of the month. So these companies take your 401k contributions as an employee, and they ship them off to the Vanguards of the world, or Fidelity, or whoever your plan is with. And that money is invested based on your requests. And they don't take that money in. Fidelity doesn't sit back and say, oh, well, now's not a nice time to get in the market. I don't think they want me to invest for them today. That's not the way it works. Fidelity sends that money in, and unless you have designated money going in the money market, or some kind of cash, that money is getting invested into whatever groups of stocks or bonds or whatever that you've requested. I've got a lot of history going back to tell me that the beginning of a calendar month and the middle part of a calendar month, all calendar months, the stock market does much better than it does in other periods of the month. So don't be shocked when you see these huge annualized returns for the 1st and the 2nd of the month, or the 15th, 16th, and 17th of the month. That's when money is flowing into these funds, and they are required to invest your money as you've authorized. So that's a really important thing if you're a trader. If you're a long-term buy and holder, who cares? Doesn't matter. But if you're a trader, you need to be aware of some of these historical tendencies that take place in the market, not just in June, but every month of the year. So that's the Russell 2000 breakdown. I thought you might find that interesting. You can always come back and listen to this recording again if you want to get that information, if you're not taking notes, or if you're interested in getting that information later. A couple of the sectors that tend to lead during June: utilities. And think about it. The S&P 500 doesn't do well during the month of June. Utilities are a defensive area of the market. The other group that tends to do well in June, the XLV, healthcare, another defensive group. As we go in, watch for breakouts on these two groups, because they do tend to perform better on a relative basis than the other sectors in June. So there's the XLV. 84 is a big level. We break 84, technically it would look good. And then, of course, we have the historical tailwinds that will help the group as well. I go back to XLU. It's got a big level of resistance coming up at 52. Now, if we go up there in reverse, start to come back down, I don't care what seasonality is telling me. I don't want to get a stock or, in this case, an ETF that's up against resistance. So we want to be careful there. But those are the two groups that tend to lead in June. So what lags in June? XLF. Financials, this has been a really bad part, or this is a bad time of the year for financials historically. So if we break down, keep in mind that June is typically not good for the financials. If we pull up the seasonality on the XLF and we take a look at the last 20 years, look at this. June has averaged going down 1.5% for the XLF, and it's only risen 26% of the years. Look at all the others, 47% and higher. So June is not good for the financials. Therefore, if we break down, you have to respect it. Let's move on to industry groups. I want to bring up a few industry groups that tend to perform pretty well. This is the water index. This is part of utilities. So utilities do well in June. This is one of the better areas of this sector in June. Average is going up 1.6% in the month of June. Remember, the S&P 500 actually averages going down 0.8%. So when we compare the water index to the S&P 500, and then we scroll back here, drag this back over the last 19 years, water has outperformed the S&P 500 by an average of 2.7%, and it's outperformed the S&P 61% of all Junes over the last 20 years. Now, I'm not going to go through all of these. You can always pull any of these I talk about up and look at them later, but I want to pull up the charts on these groups going forward. I'll give you the names of the ones that tend to do well and don't do well, but let's look at the charts and see what the charts are telling us. So the water index, very similar to utilities. If we can make the breakout above 1975, then we're getting a technical buy signal to go along with a seasonal buy signal. Software stocks. Software is the second best performing industry group. Actually, I should qualify this a little bit. The best performing industry group is the renewable energy. I didn't include it because their sample size was not very long. Renewable energy, the DW CRE index, dollar DWCREE, has only been around the last, I don't know, maybe 7 years or something like that, I believe. So it's not representative. So these are indexes that have been around much longer. But here I've got software breaking out today, the last day of May, and it's one of the best performing groups going into June. I think I want to have some representation in software as we head into June. Healthcare providers, I've been talking to how bullish I am this group. Healthcare providers are back down testing that rising 20-day moving average, but they have been very bullish, and a breakout above 1860 at some point in June, I think would be extremely bullish for the group. So let's keep an eye on the DJUS HP. Biotechs. Talked about these briefly yesterday, mentioned that I would be discussing them today. Here you've got the biotechs going back down, testing the rising 20-day moving average. We have seen a golden cross where the 20 has moved up above the 50, but really the big breakout would occur on a breakout here above about 1975 to 1980. One other thing to mention about the biotechs, I'll go ahead and pull up the seasonality on this one so you can see, but this is a group that does well not only in June, but really does well in July. So here, June, you can see it averaging 1% rise in the month of June over the last 20 years, 4.5% during the month of July, and another 1% in August. This is one of the better groups over the summer months where we tend to see some weakness on a relative basis. Actually, biotechs tend to do pretty well over the summer months. A couple of groups that do not do well. Let's pull up mortgage finance. Look at the chart. This is a group that has been downtrending. Based on their seasonality record, I would be hard-pressed to even consider getting into this space as we go into June. This is in that financial space. So just like we showed, utilities tend to do well in June. Water is an area of the utilities that does well. Here we've got financials, which tend to not do so well. And mortgage finance is one of the big reasons. This is the worst performing industry group during the month of June over the last 20 years. Another one, and I've kind of been watching this group, talked about it quite a bit here in 2018, waiting for things to kind of pick up. I thought we might have something going in this group back, maybe a week and a half ago, but it's fallen apart. Media agencies. So we're still in this sideways consolidation. I don't like this recent breakdown and movement to the downside, but if it breaks below that April low, keep in mind June is not a good month for the stock or for this group. Now, stocks to watch. What I did here, I know that the small caps have been outperforming, and healthcare providers and biotechs are both part of the healthcare group, which tends to outperform during June. So I thought I would look at some smaller companies that perform well during the month of June in these two spaces, healthcare providers and biotechs. And so what I did is I'm going to pull these charts up on these stocks. You can go back and look at the seasonality later if you like. But ENSG, clearly huge performer. I'm not overly thrilled with the amount of shares that trade on the stock, but seasonally it's a great performer, and technically it looks good as we go into June. AMED, Amedisys. This is another one. Volume is maybe just a little bit of a problem for me, but it is breaking out, has broken out. Look at the volume on this gap up here, back just about 3 weeks ago. Continues to move higher, and this is a stock that tends to do very well in the month of June. BIOS, I think this is BioScript, BIOS. I would be watching for this breakout here. It's a small company. $2.75, though, is a key resistance level. If it breaks out, I think this one has a really strong seasonality during the month of June. Yeah, look at this June. It's the best odds of all the calendar months. June goes up 63% of the time on BioScript. And look at the average return here, 7% average return on BioScript over the last 20 years during the month of June. Now, when I look at that and then I compare and look at the chart, I would be much more interested in this stock if it makes a breakout, knowing what I know about the seasonality. I mean, maybe you get in anyway, but again, for me, the technicals are the most important part of this. And so I'd like to see the breakout. But if it does break out, given the seasonal tailwinds that you have with BIOS, this is one that I would certainly be interested in. Now, it is a smaller stock, so you have to kind of weigh that. If you're somebody who doesn't like to take risk, you don't really like these small companies, then I would avoid it. I wouldn't care what the seasonality told me. So just kind of keep that in mind. A lot of this does depend on your own risk tolerance. A couple of biotechs that tend to do very well, smaller biotechs that do well in June. IMGN, look at the move we're getting today, May 31st. Look at the volume picking up as we head into June. This is one that if we make that breakout over 1150, I would not be surprised at all to see a quick trip to 13 and a half. So IMGN is one to keep an eye on. NVAX, Novavax. This is one that's been trending lower over the past I think it has a better long-term track record. Let's look at the weekly. Now, we did see some strength and a breakout above this area here. Looks like maybe 160 or so, and now we're coming back down close to the support level. A month from now, I wouldn't be shocked if we're talking about the big move that it made in June, because historically it likes to move higher in June. GERN. This is Gerin. Now, this one I think looks pretty good technically. Big move higher. Look at the volume coming in. Breakout. It's pulling back to key support right at about 425 and that rising 20-day. And we know that from a seasonal perspective, Gerin is a good performer. There is more risk in trading these smaller biotechs. I really can't stress that enough. But when you look back in June, we've averaged going up 9.7% in this stock over the last 20 years just in this month alone. But notice this, it's only gone up 53% of the time. So what this tells me is that when it's looking good technically, it tends to run. Years that it doesn't look so good, well, tends to perform as you might expect based on the technicals. It doesn't follow the seasonal pattern. But I think that the stock does look very good on a technical basis right now as we head into June. Again, a month from now or at some point in June, I would not be surprised at all to see this stock at $4.75 or $5 or higher. Last one I wanted to mention in this space, the Biotechs, Exact Sciences, EXAS, pulling up the seasonal chart. You can see over the last 18 years, it's averaged going up 12.1% during the month of June, and it's risen 59% of the time. Again, if the chart tells you to buy seasonal, this seasonal chart says, well, something you might consider. We just got to break out on EXAS. So if we get a pullback, especially that rising 20-day moving average, this is one I think you should consider. Quickly going through the NASDAQ 100, I would give you the best performers. Historically, as we move into the month of June, Vertex, need to get something technically going on here, but this is the best performer in the NASDAQ 100. I've mentioned ISRG. I do think that this is a very bullish formation. A breakout could be further confirmed by the seasonal tailwinds on ISRG, another strong stock in the month of June. SBAC, which is SBA Communications, again, technically not looking great, but maybe if it gets down to 152, 153, knowing that June is a good month and it's at support, that might be something to consider. ALXN, Alexion Pharma, another bio. This one's been pulling back. This definitely is a volatile stock. Pretty good support around 112.5, 113, though. Worth considering maybe at that level. And the last one I wanted to mention is Biogen, BIIB. This is one, I think the stock was among the upgrades that Erin spoke about earlier. Biogen doing very well. Beautiful move up. Loves the month of June, and I think also loves the month of July. Let's pull this one up on the seasonality. Last 20 years, it's averaged going up 4.9% in June, 5.3% in July. Between the 2 months, it averages going up more than 10% a year over the last 20 years in just these 2 months. 10% is a good annual return. This is a stock that's averaged doing that in 2 months over the last 20 years. But again, you don't see the chances of it going up 100%. It doesn't happen every year. So I would be only interested in years when the technicals look good. And again, if I think we go back and look at this, I think things are starting to pick up here, and especially if we get the index to break out, because I think that will bring more money rotating into biotechs, and then there'll be more money to go around in all of these stocks that we've talked about. 3 stocks that lag in June. One is Western Digital, WDC. This stock, if we go back and look at the seasonality, look at the average in June. Over the last 20 years, it's averaged going down 6% in the month of June, and it's only risen 26% of the time. Next up, T-Mobile. T-Mobile, you've got the last 12 years. It's only gone up 18% of the time. Average is going down 5.5% per June. And then the last one, and this is one that's kind of interesting because T-Mobile and WDC, Western Digital, aren't looking great on their charts. But NVIDIA has got a strong chart. But when we go back the last 20 years, look at June and July. They both average going down almost 5% over the last 20 years. And we pull up the chart on NVIDIA, and you'll see that it looks good technically. So what I would suggest here is if I had NVIDIA and we get a breakout intraday above 260 and then we pull back and we fail, I think the seasonal weakness that we tend to see in June and July would tell me to get the heck out. So watch for a false breakout on NVIDIA. As we're climbing, look at the volume dropping. There's already some warning signs. But, I still like NVIDIA, and seasonal tendencies, again, take a backseat to the technicals. But, again, if we have a technical sign that emerges that says it's a short-term sell, then move to the sidelines. Okay, let's do a quick summary of things we talked about today. And then on the heels of that, and you can go through and just check out the bullets of the different areas that we covered. That calendar day performance, by the way, I only went over the Russell 2000. There are definitely some differences when you look at the calendar day performance of, say, the S&P 500 or the NASDAQ versus the Russell 2000, but it's still worth noting, especially given the recent relative outperformance of small caps. Last thing I want to do is pull up that poll. There was a poll in the room today talking about seasonality. And when you look back over the last 20 years, because we were focusing on Russell 2000, I wanted you to take a guess as to which month has provided the best returns on the Russell 2000. 34% of you said June. That is incorrect. I did give you some numbers earlier. Many of you had already responded at that point. But I did give you some numbers on June where I think over the last 30 years, the Russell 2000 has averaged 3.8 or 3.27% over the last 30 years. Now, I know I'm saying over the last 20 years, but we could pull it up. In fact, I'm not going to pull it up now, but June ranks 9th out of 12 months. over the last 20 years, and I will go ahead and share my screen. I want to show you this. Let's pull up the seasonal on the Russell 2000. December was the second choice. And if we go back the last 20 years, December's annual or average return of 2.7% is the best. So those of you that said December, you are correct. And I would just go on to say that December, I'm pulling up, well, I don't have it up. I want to say that December's annualized return over the last 30 years on the Russell 2000 is like 38%, which is a little bit more than 3%. It would show up more than 3% here because all of these numbers are average actual returns for December, not annualized. So the number I give you at 38% over the last 30 years, that's annualized. So really what you'd have to do is take this 2.7, multiply it times 12, which would then give you roughly 32%, something like that. But I'm telling you over the last 30 years, it's actually closer to 38%. And the number of times that December has gone up over the last 30 years, I want to say it's like 25 out of 30 years. December is a great month for small caps. Okay, that is my seasonality report for June. I want to thank you all for listening to it. Hopefully it'll help in some way in your trading. Let's move on to the 10 and 10. Erin, what do you have for the 10 and 10?
All right. We've been collecting those quite a bit. There are a few questions in the chat room if you have an opportunity to go in there. All right. I'm now starting to track by Excel spreadsheet the actual requests because a lot of people get upset that we maybe do the same ones over and over. It's actually not true, but anyway, I thought I'd look at the market carpet today just for the heck of it. And let's do that price. Yep, that'll work. So looking at what we've got here, and I believe Madrigal, MDGL, I believe that's a really low price stock. And I think that's why we're getting these big readings. Anyway, let's go ahead and get started. Everybody get your votes in the chat room if you're watching live. Like the symbol requests. It looks like right now the one that is winning for the second one will be, there's almost a tie between Walmart and Snap. So get in there and make your votes, and then we'll see which one gets selected. But I'm going to pass it to you, Tom. Start with Nike.
Yeah, I've said before, I really like Nike. And so hopefully this chart will kind of show you why. But this was a stock that had been consolidating. Keep in mind, the S&P 500 has really been struggling. We're nowhere near those earlier highs from 2018. And yet, over the past couple of weeks, we've seen Nike breaking out. So Nike, which is an international company, so it's just like a lot of the other companies, it's going to get hurt a little bit by the rising dollar in its next quarterly report. But on a relative basis, this is a stock that is going higher despite those potential concerns. Volume here I highlighted because we're getting a breakout above a very important resistance level, and I like to see that volume spike on the breakout. So I think just below 70, let's call it about 69.80, 69.90 is a great support level. But I think Nike is one of the better performing stocks in the Dow Jones, and I look for it to go higher.
All right. The most popular looks like, which one won? Walmart. Walmart did win. WMT.
Yeah, on a relative basis, this is an ugly performer. And so let's pull up that relative chart and annotate this one. Clearly, the first thing, I mean, I'm a momentum trader. So when I look at this and I see this, I'm going to have some issues. Now, good news. I think we're really close to a major support level on Walmart. We could move it to the bottom of gap support right here from the second week of October, which is around 79. I could go to the prior high from back in August, which is about 80, or I could go to the top of gap support, which is about 81. But I really think that the area in here between 79 and 81 is great support for Walmart. This is where I would look maybe for a reversing kind of a candle. It's in a good group. There's nothing wrong with the broadline retailers. And so that is good news for Walmart. I mean, if you take a look at the group on an absolute basis, we're breaking out to new highs right now. But the problem I have is that on a relative basis, we do have some problems. And so here's Walmart relative to its peers. It just keeps dropping. So you got a great group, but not so great stock, except that we are getting close to a very important support level. I could begin to make some arguments to buy Walmart in this area from a price support and gap support basis, especially if we move back down to another low and you see the volume is light. I think that would be a pretty good clue that maybe the sellers are winding down. But you're in a good group. So if we take a look at the relative strength of the broadline retailers versus the S&P 500, you got a lot of relative strength. So it's not that the money's not rotating into the group. It's just that it's not rotating into Walmart. But that could change again with this support level. So I like Walmart. I think we could see a bounce in that 79 to 81 area.
Okay. The next one I have for you, requested via email early this morning, is J. Jill, symbol Jill.
All right. Okay, we're testing the upper end. I mean, I love the volume coming in. I don't want to chase this stock here. And one of the reasons why is if we leave this long tail today, if we come back down and close below, say, 740 or so, we're going to have a long tail above gap resistance and a close beneath it on heavy volume, which is telling me that, this move up, which was a nice breakout, may have just been encouraging some folks to jump in on the long side, and then the carpet got pulled out from under them. So be careful if it closes back below 740. I could see this as a short-term top, maybe start moving back down toward filling this gap. If we finish above 740, 745, I think you have a better chance to extend this rally up to 875 to 9.
All right, let's see the next one. Very popular. We haven't looked at it in a while. Snap.
Yeah, Snap snapped. And it's actually coming back a little bit today. So this could be another stock that I would watch very closely into today's close, because this is a major level to clear on a closing basis. We opened beneath it, as well as opening beneath the 20-day moving average. We are trying to take out this tail up here. If I was in, or if I got in on what was perceived to be a breakout, I would have a stop in at the end of the day. And if we do go back and close below the 20-day moving average or below this breakout level. So I think Snap looks better today technically, but this could be a major head fake if we reverse later today. So I think today's close is going to be very important technically for Snap.
Okay. Our token consumer staples. There's always one, and today it's Clorox, CLX.
Yeah, this is probably another one just to throw in here on the relative chart, because we've got a stock, obviously, that's not performing well. We just, and this is what I was just referring to about trying to get through a key resistance, gap resistance. And so I want to show this first. Looks like maybe we closed just above that gap, but we did leave a tail up above and then immediately came right back down following the overall trend here to the downside. I think this 20-day moving average here is very important for Clorox, because we've got a breakout that just happened at about 121, and that is almost exactly where the 20-day is, at 120.65. So if this selling continues today and we close below both the price support and the 20-day moving average, I have a feeling we're going to head back down and test this low around 113.50. I have a problem with many of these consumer staple stocks just because the money is rotating away from consumer staples. And you can see that the overall group here, the DJUSHN's been down. Clorox on a relative basis hasn't been horrible. It's just part of a horrible group. So I would pass on Clorox. And again, if I was in it and I closed below that 20-day today, I would really be careful.
All right. Actually, our only energy sector stock, Sunrun, it's renewable energy equipment, RUN. Looks like a breakout.
Yeah, RUN, I think I've spoken about recently. I know they've reported great earnings. I know they're on my strong earnings chart list. It was back here. Yeah, this is a nice breakout, and I think it's a great looking pattern. My biggest problem with Sunrun, could be Funrun. It looks like it's a fun run so far. My biggest problem with this stock is that it is a small company in that renewable energy space. And it's almost like Biotechs. These stocks can be up, crazy 1 or 2 days, and then all of a sudden, I mean, check out what happened in April. The stock went from $10 down to $8.50 in a day. Went down a little bit lower. 4 days, it was from 10 to 8. 20% of the stock price gone in 4 days, and then it just resumes the uptrend. So you've got to be willing to take on that volatility and risk. But I love the chart pattern. I think that this is a great breakout with solid volume, sideways consolidation. That's a flag, and we're breaking out, and the volume is confirming. I think it goes higher.
All right. How about Express Scripts? ESRX. Looks like a failed double bottom going on there to me.
Yeah, just consolidating. It's moving in a range. So we've got the double bottom right here. I think that Erin was referring to. What you look for is to come back up and take out this prior high. We haven't done it. We did have a big gap up back in earlier in March, and this is part of the healthcare space, which typically outperforms in June. So I think a breakout above $78 would be very bullish. And if you're looking at this as an uptrend with the PPO breaking above centerline resistance, then I think one thing that you want to see is on a pullback, the rising 20-day moving average hold. So if we get a hold here, this would be a more aggressive entry point, I think. But if it holds, then the breakout above 78 would be very bullish and would likely take you back to that 85 area.
All right. We haven't looked at Etsy in a while. This is one I wish I'd been holding for a lot longer than when I sold it, but that's okay.
Yeah,
Just got a PMO buy signal on it on this breakout, so it looks like it's ready to make some more of a run.
This is a classic consolidation after a negative divergence. I was concerned about this stock only in the short term because of a negative divergence. I mean, you could see really coming across here, or we could draw the line here, however you want to do it. But essentially, we had much lower PPO and a much higher, prices continuing to rise. So what you normally are looking for there is a centerline test on the PPO and a 50-day moving average test. Because if you notice, the 20-day moving average continued to hold as support. But once that negative divergence kicked in, look, I think this may have been earnings right here. And I think they came out with pretty positive earnings, but stock went down anyway and got that 50-day test. We consolidated, and I think it's making a breakout with the PPO turning higher. I agree with you. I think it's a bullish development here. I like the stock.
All right. The next one in the telecom equipment area, Comtech Telecommunications, CMTL. I would be worried about, I've got a negative divergence on my PMO. It looks like a head and shoulders off of this gap up. I don't know.
I think it's consolidating. I'm fine with it. My biggest concern is that it doesn't trade much, except for the big pop, which I'm assuming was probably earnings. The volume's drifted way down. Today it's traded 67,000 shares. Probably not enough volume that I would be interested in this stock. But I actually see, if you actually take a, kind of look at all of these candles here and kind of squeeze them together, what we have is really a flagpole there, flag action. We did get a breakout. Went a little bit lower on this pullback than I would have liked to have seen. I think the next thing you're going to see, though, is a breakout here. Again, I wouldn't do it because I don't like the volume, but I think we've got to move to the upside, followed by consolidation. I would expect it to resolve to the upside.
All right. And our final one is going to be DMC Global. Symbol is boom. So boom, baby, the last one for the 10 and 10.
Boom, or run DMC Global.
Go.
Yeah, I like this move. It's another one that volume would concern me, but I like the chart. You might say, well, it keeps going up and there's that negative divergence. But I would also argue that with each one of these moves to the upside, this volume has been pretty heavy compared to what we had seen in the past. So this is one of those situations where if someone tried to argue with me that they're slowing momentum, I don't really see it when you've got volume that is above average as the stock keeps rising. I think that's accumulation. That is not slowing momentum, in my opinion. I've done, trading secrets using the MACD in the past. It would be the same with the PPO. And one of those secrets for me is that I ignore negative divergences when I've got volume confirming in advance. So I like this stock. I think that the key area that I would follow or look for in terms of support is right there. We had a breakout. I'm going to just draw a few levels here. This is a major gap support level on heavy volume. I don't believe you're going to see a close back below that level anytime soon. Then we sideways consolidated. We broke out, went back, tested that breakout level, and now we've broken out again, and now we've been holding this $42 level. I think as long as it remains above 42 and in an uptrend, I'd hold it. I like it.
All right. And that completes the 10 and 10. And let's see, we should have those stock symbols up for you. There you go. I will get these up in the Market Watchers Live chart list. So you can see all those annotations, save those charts to your own chart list. Just go to the blogs tab and click on the Market Watchers Live blog. And there at the top, you'll find the live chart list. Okay, I am going to move on to talk about something that is coming up in August. Our regular viewers, I think you all know what's coming up in August. August 10th and 11th, ChartCon 2018. Our theme, as you can see, is reducing risk in uncharted waters. And this should be an excellent conference. Don't worry about it if you can't travel to Seattle, because it is streaming. The conference is actually a streaming conference. So you can participate. We will have opportunity for social networking. And the main thing, of course, to tune in for are all these amazing speakers that we will have. I'm looking forward to a few of these in particular. Dr. Elder, who I always quote his book for you. Also looking forward to Tushar's, and, well, Tom, I'm looking forward to yours because I know you're going to do a great job as well.
Thank you.
So here is our agenda, and highly recommend you go ahead and sign up for this. It's not that expensive in the grand scheme of things. $250. You'll get not only the live streaming and being part of that event. Even if you can't be there live, you will get all of the recordings, and you'll be able to hold on to those for historical purposes if you want to go back and get a refresher on what everybody talked about. So highly recommend you go check that out. And now it is time for our final market update. All righty. Okay, so I'm going to start right here on the home page for our predefined alerts. You can get this on your home page if you'd like. And these are our headlines for today. At this point, we've got the TSX crossing below the 16,000 mark. That was one of our alerts that came in earlier this morning. And you can see gold has crossed above 1,300. So I'm going to look at what's going on in our markets right now with the candle glance, and then I'm going to take a quick peek at gold. And here we are. So obviously market's lower, although I'm seeing some possible double bottoms setting up here intraday. We are starting to see the market try and make a move back up. The S&P 500 got really close to positive territory, but has fallen back. The NASDAQ is in positive territory. And interestingly, we're seeing this rounded top on the Russell 2000 succumbing to the downtrend, but techs seem to be doing all right with the NASDAQ up slightly, up 152. We can see Wilshire 5000 is also looking very similar to the S&P 500, double bottom possibly setting up here. Treasury yields are almost unchanged, reading 2.839%. UUP is mostly unchanged, down 2 cents. Commodities are lower on the day slightly. We can see USO is taking a bit of a hit here, reading at 1358. It's down 25 cents right now. GLD gold mostly unchanged, likely because we're seeing the dollar mostly unchanged. VIX is rising, but has pulled back a little bit today to 1525 off of that high we had near 16. And advances, obviously declines leading advances over yesterday. And I'm going to go take you very quickly to that gold chart because I did want to talk about it. I talked about it before. Let's see here. Go to my list. I'm sorry, I meant to have it right up here. And then we'll get into our just make it stop. All right. So what I pointed out yesterday, I did my regular DP alert article. So I went over the big four, all of our indicators, and of course the S&P 500. Highly recommend you go check that out in the Decision Point blog. But one of the things, yes, we got over 1300. Obviously, we managed to do that yesterday as well. What I've been noting is this 1310 level. That's really the area I would like to see gold pop above. It's not doing it. You can see that the PMO is starting to look good, though. We're just about ready for a buy signal, and the scooter is improving. I wanted to make note of the fact that it looks like the dollar and gold are decoupling somewhat. Their correlation, their reverse, almost perfect reverse correlation is starting to give way. So while you will generally see gold do the opposite of the dollar, it's actually not doing so bad in relation to the dollar when you're looking at that correlation. So I'm watching that 13 level closely. This was really interesting. We got a premium on the Sprott Physical Gold Trust, and that means that there's a lot of bullishness actually out there for gold. And so when you see the sentiment move so bullish, that makes me bearish. I'd be a little concerned about that. But you can see yesterday's, I'm sorry, that was the 29th, yesterday's, it came right back down. So keeping an eye on that, but that 1310 level I think is far more important than the 1300 level. With that, I'm going to conclude our final market update. And we can go ahead and move into Just Make It Stop. Although, did you have anything you might want to add, Tom, to that market update?
No, not really. Just been kind of a crazy few days in the market, that's all. And just the fact that the market is much more volatile than we had seen it throughout 2017. So the market is still reacting to news, although volatility had settled down quite a bit prior to this week. But we're definitely seeing it pick up again with the action so far this week.
Absolutely. And here's just a quick peek at the VIX on the chart over here. And I did write about this yesterday as well. We had what I think is going to be a buying initiation off of these climactic breadth readings, and then the fact we got that penetration below my lower Bollinger Band on the VIX inverted. All right, so Just Make It Stop. You want to explain this one, Tom, while I get my charts ready, or do you want to start it off?
No, go ahead and get your charts ready. It's a new segment. It's really maybe taking a look at the darker side of trading when you lose money. Not every trade, not every trade goes the way we think it's going to go. And unfortunately, it's a necessary part of trading to just make it stop. Stop the pain, stop the hurting, stop the negative effect on your portfolio. There's got to be a point at which you just decide to make it stop. And so that's really the whole thrust of this segment, is to look at some charts. They might be similar to anatomy of a trade. They may be actual trades that we've had, or they just might be some stocks that have kind of garnered our attention. I think Mark Chaikin yesterday looked at Albemarle, ALB, and I'm going to look at that one again in just a few minutes, because you get signals from these stocks. Technicals change, character of the chart changes, and you've got to be willing to let these stocks go when the character changes, even if they rebound later. I mean, I know everybody has that feeling. I've had it plenty of times. You'd say, well, if I sell it and then it comes back, I'm not going to be happy. But really, the key to successful trading is to minimize your losses. It's not necessarily to hit on every trade that you place. It's about minimizing your losses and letting your winners run, if that's your strategy. So Just Make It Stop is just a segment where we're going to take a look, like I said, at the darker side, some of these stocks maybe that are going against us, or just charts that have broken down, and give you some ideas of things to look for to make it stop.
There you go. So I pulled up a couple of requests we've had recently in the 10 and 10. Thought I would look at them. I think GE is probably a great one to start with. I think a lot of people said just make it stop as far as GE goes. I'm saying the same thing because I did get in, and I think I got in back here at around 14, somewhere in that 14 range. But anyway, what I'm going to go through here is where I think you should set your stops, and then, you know, you got to live with them. And right now, I think GE is right at a stop point. And I am actually, my finger is on the trigger here to go ahead and just take the loss at this point. So, you know, this seemed to be the great point to drop in, right? We had this reverse head and shoulders. We got the breakout back here. And that's where actually I think I bought it right around 15. So I'm feeling the pain. It's gotten low enough now. Honestly, we had a pretty good warning with that big drop, but see, you know, once the big drop happened, I was pretty much there. I'd set my stop right around the 14 level. And typically, guys, I do set mental stops. I don't necessarily make them hard stops, you know, put the orders in, mainly because I can watch my investments. And the other is that sometimes I just, they're more buy and hold. So I'm not going to be paying quite as much attention. So then I might set that hard stop in there. And then I highly, highly recommend, if you are in any stock that is in a parabolic move, y'all love being in them, I love being in them, set a trailing stop. You will not be disappointed. That's all I can say. It has saved my bacon on some parabolic moves like you would not believe. So anyway, here's, this is the feeling the pain. You got to just make this stop, guys. We got the fake out breakout here on what looked like a reverse head and shoulders. It took that dive. At that point, it came up to the 20. It failed. Like I said, I was still holding on to it. Bought it back here at around, I think it's right around 15. I'm still holding it, but watching very closely today because I'm going to want to just make it stop if it closes below 14. So keeping an close eye on that one. Let's make it stop. How about JP Morgan? So what I did here is I marked when I would have gotten in right around, I'm not actually in this, well, I am in it, but it's a very long-term buy and hold. We have the PMO buy signal. So I'm going off of that if I had bought in there. So that would have put me in at about what, 111. Let's just say we got in there. So what I would have done, my stop would have been set right here, right around that 109. Not only does that match up, well, you can't see that gap because we weren't there yet. It matches up with all of these support tests that did hold earlier. I thought that looked like a pretty good area to set that stop. When you get the move up, you're looking for your target to be hit. Well, obviously I have my target, you know, I had it pretty high, even at that 115 level. So what would have occurred? I would have watched this. We would have come very close to hitting that target. That's when I would have reevaluated my stop. My stop was way down here at 109. Well, if I'm holding this stock at about 114.50 at that point, it's time to reevaluate. So I would have raised the stop probably to about that 20-day EMA. That's why I'm marking that point. And that would have set my stop. I would have been right around the 115 area. I would have probably set my stop right around 112. And I could see even in a very short-term trade setting it at 113. But I'm going to say more than likely, if I had been in this trade and it was up here, I would have probably been looking right around that 111 area as my stop area. That would have been where I would have moved my stop. Well, of course, I would have seen the change in the direction. We would have seen the change in the 5-day EMA moving lower. But it came down and it triggered. It would have triggered right here at about 111. And while I would have probably been, you know, hitting my head against the wall as it started its move back up, saved my bacon because we ended up with that failure. It did hold the 200-day EMA, so I might be reevaluating this because we do have what could be an island reversal setting up. But that was one where I would have not come out that great on the trade, but it did save me the heartache of what happened later. Schlumberger. All right. So here we go. I'm actually going to switch this into a 6-month chart and make my bars a bit thicker here. Here we go. A lot easier to see. All right. So I'm going to hypothetically get in here. I would have seen the bull kiss, we'll say. That seems like a reasonable area that I would have gotten in, right around $71. So we're going to say we were at 71. So where would I have set my stop? My target, my upside target, was way up here, right at 79. So I don't mind setting my stop a bit lower than that. So I would have likely set my stop back here to where we saw this area of overhead resistance. I would have been very happy, obviously. Once it got up here and I had that kind of a gain, I would reevaluate. Like I said, I think that's the really important thing to do is as you're watching your stock, if you're seeing, the trends are looking good, great. When you hit a certain percentage gain, and that's in your head, whatever you want to make that, then you should reevaluate. And that's when you can raise your stop and think about that. So in this case, right about here, after I got that breakout above the 5-day and then had another nice day, I would have gone back and set my new stop at about 72. Of course, darn it, it would have ended up triggering before I reached my upside target. So I would have gotten in here, what at about, we figured about 71, and I would have ended up out about 72. So I would have preserved a slight gain, but not much. But it made it stop. You ended up missing out on that gap down, and now it's consolidating. Again, this might be one to consider as an island reversal for later. But that's how I would have set my stop there. I'm going to pass it back to you, Tom, because I'm running out of space. I didn't realize it would take me so long to go through these.
Okay, not a problem. Let's go ahead and take a look at a couple of charts. Now, one that was mentioned the other day by Mark Chaikin, actually yesterday when he was with us, was ALB. And he had pulled up a daily chart. And I think I mentioned during the show, on a weekly chart, that the stock really, the character of this chart from a technical perspective had really changed. And so I could go in and annotate, but I think you probably can see what happened here. And that is that we had a beautiful uptrend in play, and it had been in play since the bottom in 2015. But if I just connected, say, these lows right in here, we had a pretty nice little uptrend going. I mean, I could have done all kinds of different, I could have done that. I probably could find other, but no matter what you're looking at in terms of trend lines, this move down right here, this candle, and that reversal of the uptrend on this kind of volume, 17, 18, 19 million shares, when we hadn't seen that kind of volume in a year and a half, that is a character changer on the chart. So I'm looking at it first from a long-term perspective. So for somebody who maybe is a buy and holder, who is looking and, is willing to hold through some of these periods where we pull back or go sideways for a while because there really isn't anything bad going on. I think when you start seeing moves like this, big volume, and if the first one didn't get you, certainly the rebound, failure to get through the 20, and a second one on massive volume, at some point you got to make it stop. And so this is, again, a longer term chart to maybe be thinking about, but I'm going to pull up from a daily perspective and look at ALB. I won't spend too much more time on this one because I know Mark talked about it yesterday. But here we got a breakout. I mean, it looked like we were starting to maybe turn higher. And so, and if that's the case, then you should have some thoughts of where you would be interested in pulling the trigger as things started to break back down again. Now, volume picked up. It wasn't a huge pickup in volume, but definitely a pickup in volume as we cleared what I thought was the biggest, prior support and then resistance on this particular chart going back 6 months. We had stopped around 103 as support. We bounced, and then we lost 103 on very heavy volume late February into early March. The bounce was on anemic volume, came back up right to the prior support level, which becomes resistance, and we failed. We went just a little bit below the prior low, and then we started making our move to the upside. Now, there are a couple of things to look at. I mean, I guess you could draw a trend line. You could do whatever. For me, it's about price and volume, the combination of price and volume. So breaking out above 103 to me is a big deal. And the fact the volume did pick up, I would be looking for more follow through to the upside. And we just didn't get it. We went up 1 or 2 more days, but this is not exactly excitement after you make a breakout above a key resistance level. So we pulled back, went all the way back down. For me, it probably would have been price support, but maybe I could have made an argument at the 20-day moving average. This volume picking up and this kind of a candle to the downside, losing $6 or $7 on very heavy volume after a prior downtrend that's been in play. And again, if you step back, look at that weekly chart, it's really hard to make a bullish argument for ALB. So those were 2 different ways to look at it, from a weekly, longer term perspective, and then also on a daily, short term trading perspective on different levels maybe to be looking at to make it stop. And I wanted to do one other one. I think it was AYI. I'll just do it very, very quickly on the daily. But there are multiple levels here. I don't know if this was earnings or maybe this big volume here may have been earnings. Actually, I think they do report early in the quarter. So I think this was probably earnings related. I make some things stop because I won't hold into earnings anyway. I think that is, I don't know, maybe you like that roulette wheel. I think it's a little bit deflating, though, when you hold a stock into earnings and lose 10% the next morning. So I don't like to do it. But you had a downtrend that had been in play for a long time. You've got to be putting in stops at prior lows. If it breaks down again and you got the volume coming in, you just got to get out. I mean, if I was still in this stock and it gaps down here, I'm getting out. I'm going to make it stop. And yeah, it bounced back for a few days. And if you're perfect in your timing, maybe you could have gotten out there. But look at what the stock has continued to do. It's been a very, very poor performer. So anyhow, that was really all I had. So we had several examples of how maybe you can make it stop, both from a longer term and short term perspective. We'll bring up that summary slide for you. And sometimes you just got to make it stop, Erin. And I think you're on mute.
Somebody asked us, do you calculate what your stop would be before entering? And I would say, yes, 100% of the time I do that.
Yep.
Because you have to have some threshold, right?
Absolutely. I've always got a stop in mind. It may not be a physical stop. A lot of times for me, it's a mental stop because I can watch the market, but I always have a stop in mind when I get in.
Absolutely. Let's see. We've got to wrap this up already. I can't believe it. Great segment on seasonality, by the way, Tom. I really enjoyed that.
Thank you.
I will be doing a monthly chart review for the Decision Point Report. All of the monthly charts will go final at the end of the day. So we'll look at all of those signals. I have a workshop coming up next Tuesday, this Tuesday, I should say. If you have any suggestions for what you'd like me to talk about, go ahead and put those in the survey. Charlie Kirkpatrick will be here, and on Wednesday, and on Friday, we have everything stock charts.
All right. Thanks to everybody for stopping by. Please remember to complete that the survey as you exit. Erin would love to have some ideas for topics for her workshop. And also, we'd love to get your feedback to hear what you think of Market Watchers Live. Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Thursday afternoon, everybody. Hope to see you back here on Friday. Happy trading.
Volatility is back and interest rates are rising. With the markets headed into uncharted waters, ChartCon 2018 is here just in time. See how the experts are protecting themselves and watch live from the comfort of your home or office as they reveal the risk management strategies they use to stay profitable in any market. Plus, you'll get complete video recordings to watch on demand for years to come. Join us at ChartCon 2018, streaming live August 10th and 11th.